Now, the 7 sins of fund management broadly focus on those self-imposed activities which broadly fail to add value to portfolio returns. But what are they? Firstly, forecasting doesn't seem to work, and this is probably secondly compounded by the fact that we think we have more knowledge than the next investor. Thirdly, meeting companies doesn't necessarily make us smarter investors. In fourth place, think again if you think you can outsmart everyone else. Fifthly, short time horizons and overtrading only detract value. The 6th sin deals with believing everything you read, and number 7 rounds things off with group decisions. 7 sins are a lot to deal with in only 30 minutes, so tonight we kick off with the first in a second-part series dedicated to addressing these so-called fund management evils. On the agenda for this show is sin number 1 to 4. Gentlemen, welcome to the program. Great to have you on. I think let's start off by talking about how you repent for your sins. And Adrian, let's start off with you. And that's, of course, I'm assuming that you are someone that is embarking on some of these 7 sins, or not.
Lovely. What a way to kick off. I think it's fair to say that anyone involved in any type of decision making, and obviously we're talking here specifically about investment decision making, but you could even take investment out of that statement. I think anyone who is involved in decision making to some degree or another will have the tainting or influence of each of these 7 sins in some shape or form.
Are you completely innocent?
I strive to be innocent because the work that James has put together in describing the 7 sins of fund management, it is hard to fault the arguments. I think that they carry a tremendous amount of weight, and anyone who is responsible for stewarding investments and trying to make really good investment decisions wants to pay a lot of attention to these factors.
I mean, let me also say that if you listen, if you read the paper, The 7 Sins of Fund Management, as James Montier has written it, you have to be a little bit of a behavioralist, and you have to understand kind of quantitative work. If you were only a quant and you didn't understand anything about behavior as far as markets were concerned, I think you would probably battle to understand it. And that's what makes the market such an interesting place. Some people will read it and say, well, let's discount 90% of this, let's discount 50% of this, because we think that, you know, some of these things don't work. So you actually have to have this kind of this kind of dual process when actually reading the research.
Okay, so how do you
repent?
My question, though, because I asked a question.
To answer it.
Exactly. Are you guilty?
Well, how do you?
Any of the 7
well, you
sins?
answer, how do you repent? Well, you don't get returns, and the industry will tell you then that short term, if you don't get returns, then you shouldn't get any fund flows either, or you should really battle to attract new clients. The problem, though, that you face is that most investments should be made with a long-term time horizon. And most people don't look long-term, they look short-term. So we say, this fund manager has done well over the last 6 months. It means nothing in the greater scheme of things. You should be measuring people over very long periods of time, 10 years plus.
Okay, so let's start off with the first sin, forecasting. Can you avoid forecasting? Because I see that people try and forecast earnings, they try and forecast the macroeconomic environment. We can't avoid forecasting in a sense, Adrian.
Yeah, Eleni, I think forecasting needs to be separated from thinking about the future. James's point in the 7 sins is that it is specifically using forecasts to guide your investment decision or to inform. So you're saying, I figure that in the next 12 months, earnings are going to be R1.12, or the interest rate is going to be cut by 75 basis points, or economic growth is going to be 4.2%. And based on that pinpoint forecast, you take an investment decision. And the evidence that we have is we are very poor at forecasting.
Absolutely, but I know that forecasting has an integral part to play when it comes to creating strategies for asset managers. Is that the wrong perception?
Well, I think that, again, you want to separate out the pinpoint forecasting from thinking about or trying to see the future. And if you take the case of buying a company because you believe that earnings next year are going to be R1.50 and that's a surprise to investors, and on the back of that you think the share justifies a higher rating, you're likely to be disappointed. But looking at a company and thinking this company is likely to be profitable in the future, or this company is going to experience some turbulence, I'm not so sure that that is what we would refer to as a forecast.
Okay, so Montier essentially says that we should ignore all economists, strategists and analysts, essentially.
Well, I mean, he's not, and as a matter of fact, he wrote his research while he was working for a sell-side analyst, meaning Dresner, and today he works for GMO, which is more on the buy side. So he works for an asset manager today. And you can kind of understand why he's made kind of that move from sell-side to buy-side. but he's pretty critical about the sell side industry in the sense where he says, well, most of the sell side comes up with forecasts, and their forecasts are generally rosy and based upon a previous number because they have to sell research. And how else do you sell research if you're selling something that's quite dismal relative to where it was before? I think from a buy-side perspective and from an asset management perspective is, if your starting point for valuation is that something will go wrong, and it's just a matter of time before something does go wrong, and now let's secondly, and the second phase to that is, let's now try and put a value to an asset, a value that you're prepared to pay for the asset. That for me would be a value-based argument. Whereas if you're forecasting, you're saying, you're not saying something's going to go wrong. You firstly say, what's the next value look like? And you base that upon GDP growth and interest rates and inflation and economics, so to speak. And that's kind of dangerous to do. And as a matter of fact, most of the work that James Montier has done, if you look at some of the graphs that he's drawn, he goes and he looks, for instance, at economists, and he says to economists, okay, what does your next number look like? And then he looks at what the actual number comes out like. Now, usually what happens is they overdo it on the top end and they overdo it on the other end. So once the number kind of peaks, they over extrapolate the number, and once the number actually starts decreasing, they say it'll get much worse than what it actually gets. And that just shows you forecasting just is very, very difficult to do.
Okay, let's get into this. The second sin. We know the first sin is actually forecasting, which is linked to pride, and the second sin is the illusion of knowledge, which he says is linked to gluttony. So I mentioned it in the introduction that it seems that most investors are of the view that they know a lot more than the investor next to them. It's really tough out there. We've got a lot of information that we need to sift through on a day-to-day basis. How do you pinpoint what you should be looking at?
Kobe made the point about us being victims of different illusions, and in the case of the knowledge illusion, the argument is that the more information you have, the better you're going to be, the more effective you're going to be at decision making. Interestingly, there's a lot of behavioral research that has gone on behind this, which is also a point Kobe highlighted. And the behavioral research that goes on behind this refers to the forecasts or prognoses made by medical doctors, car mechanics, horse race punters or horse punters at the racetrack, and in each case, as the decision makers were given more and more information, they became increasingly confident about the quality and precision of their assessment, and they were increasingly poor in their decision making. So the idea that the more information I have, the more effective I'm going to be, is a remarkable illusion.
That's unbelievable, because we know that knowledge is power, and this is what we actually hinge a lot of the decisions
That's what we
make.
believe.
That's what we believe. So are we disputing this fact, Kobe?
Look, I think that in markets, generally speaking, there's a couple of factors that you need to take into consideration in order to make money long term. As a matter of fact, we're looking at one of those portfolios in the fund focus section, where it just takes a couple of factors into consideration and says, well, if you get the basics right, then you should be okay long term. Now, the question is, or the answer to that to most investors is, no, let's make this thing way more complex than it actually should be. And I think it has something to do that a lot of people actually believe markets are efficient. So a lot of people believe that if I know something today that Adrian, say, for instance, doesn't know, then I could benefit from it much more than he could, for instance, benefit from it. So therefore, I research and research and research and research, and I watch every single TV show, and I devour every single newspaper and all the economists I could potentially find. But does it make me a better investor? No, probably not. Get the basics wrong, you're going to get no return. Get the basics right, and you do get a return. And that's just as simplistic as it really gets. The other thing you must also consider is that a lot of analysts and a lot of asset managers have to appear to be very, very clever. And how do you appear to be clever? Well, you show a lot of knowledge. You say to people, look how clever I am. Let me show you how this thing can really play out. And most investors don't like for you to say to them, look, I tell you what, buy cheap stock and you're going to get return.
Maybe I'm of course making an assumption here. I'm sure that you are guilty of gluttony. The illusion of knowledge. You must be. I said in the introduction, Dr. Adrian Saville, which means that you obviously have a PhD.
A search for knowledge, yeah.
Yes, exactly. And I think we're all guilty of it, and it is expected of people within the industry, Adrian.
Absolutely. And I think that each of these are traps that are very easy to fall into. These are holes that are they're abundant, and it's almost self-evident that you would go in search of as much knowledge as possible. There is a difference, I think, again, between going in search of that knowledge and acting on that knowledge. So the case in point is the Superdogs portfolio that I run, and that Superdogs portfolio emphasizes just one or two key factors, and this reinforces or perhaps endorses the point that investing is actually quite simple.
Sin number 3, lust. Or meeting companies, essentially. Okay, and what Monty actually just really focuses on is that, he says that it's very difficult to tell truth from deception. So when you go and meet companies and you understand how the business is run, you believe that you understand the fundamental aspects of the business. Kobe, let's start with you there.
I mean, I think that's, firstly, remember that companies suffer from exactly the same biases as what fund managers do. So guess what? When it gets to forecasting, they do exactly the same thing. When things are tough, they say, you know what, it's going to get even tougher. And then it'll get even tougher. And at some point when it gets better, they'll say it'll get even better. I mean, I charge anybody to sit through 12 months worth of results meetings with companies where they propose what they're going to be doing with their businesses, where they run through the income and the balance sheets, and where they get asked a myriad of questions by analysts. And will you become a better investor by doing this? Probably not. Because again,
but then you understand the company, Kirby.
Well, you could understand the company by reading their annual reports.
There's a great piece of work that's done by Duke University, and Duke goes and surveys chief financial officers. And the chief financial officers consistently forecast that their company is going to do better than the economy and all of their competitors. But collectively, all CFOs are making the same forecast, that we're collectively all going to do better than each other. This is, overconfidence. And the other aspect to this is what is referred to as the Stockholm Syndrome. And the Stockholm Syndrome relates back to the case where people were taken hostage in a bank in Stockholm and fell in love with the hostage takers, became in awe or sympathetic to them. And as a result, when the matter went to court, refused to act as witnesses against the hostage takers.
Unbelievable. Do you send your employees out to meet companies?
I knew that you would ask that.
Do you? I'm sure you're guilty of this.
We do, but I think that it would be fair to say that we are overwhelmingly at the low end of management visit on the spectrum. There are cases where you do want to get soft underbelly information, but you want to be acutely aware of this risk.
But maybe it's also fair to just point out that if you're in the private equity space, for instance, and there isn't public information available, say for instance on companies, you would want to meet with management. It's important for you to actually sit down and actually understand and be able to actually go through the nitty-gritty. But if it's a public company and all the information is available, surely your bigger task is understanding earnings and what drives those earnings. And quite frankly, there's nothing in an annual presentation they can tell you to make you understand that. Surely. Let's take British Petroleum as an example. Take BP as an example. Just before the crisis happened, off the Gulf of Mexico, the CFO would have told you, fantastic buy. $60 per share, fantastic, buy it.
$10 billion of cash on the balance sheet.
What's the problem here?
And
then something happens, and that's why I say assumption number one, always assume something will happen.
All right, sin number 4, we have to get things moving. Sin number 4, envy, thinking you can outsmart everyone else. And isn't that what this game is about? Thinking you can outsmart everyone else because you can offer investors better returns. Essentially, isn't this inherent in all of us, Adrian?
Yeah, again, I think that these are behavioral biases, and in each case, an investment manager is in no way immune to these human behavioral biases, whether it's about overconfidence, your ability to see the future, the fact that you can set yourself apart from the crowd and distinguish yourself. I think every person has these elements in their behavioral makeup. This is not a case of am I somehow immune to these components? We all have them. It is, am I conscious of these components?
We're getting very philosophical.
Well, I mean, I think it's a philosophical topic. I mean, the other thing as well is remember that if you think you can outsmart other people or other investors, you might
value investors, for example, believe that they can outsmart growth investors.
This is why if you look at the mid-90s or the late 90s and you look at the American stock market and you look at the valuations you were buying stocks at, this is a classic case where people are saying, I can outsmart the next guy. Yes, I'm a value guy, but I'm not prepared to be a value guy in this kind of cycle because I'll show you how I can outsmart other people. And then you increasingly no longer keep to the rules, and you're increasingly buying more and more and more and more expensive stock. And that is a classic example. And that's why I think the 7 sins is something that fund managers should really put on their walls and say, am I doing this? Am I doing this? Am I doing this? Is this something that I'm kind of keeping true to?
All right, let's wrap up the 4 sins that we've covered. Of course, we did forecasting, we focused on the illusion of knowledge, meeting companies, and number 4, thinking you can outsmart everyone. So just a wrap on those 4 sins. Adrian.
Yeah, I think that what you want to do is build an investment process that recognizes that these are vulnerabilities in decision making, and wherever possible you put safeguards into your investment process to try and protect you against those.
Kobe.
Don't sin.
Don't sin. Well, as soon as you're innocent, you can let us know.
Absolutely.
We have to take a short break, but we'll be reviewing the fascinatingly named Superdogs portfolio when we come back. Stay tuned.